Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and today we're going to be talking about tax diversification and investing, how to reduce taxes with investing, and which type of account is best. So tax diversification, as it relates to investing, refers to the strategic allocation of assets among multiple investment accounts with varying taxation. For example, tax diversification can help an investor choose between using a Roth IRA or a traditional IRA. It can help investors determine when to use a regular brokerage account instead of an IRA. The best application of tax diversification may require using all three types of accounts. So tax diversification, let's define what that actually is. Tax diversification is the allocation of investment dollars to more than one account type. Tax diversification is similar to tax location, not to be confused with asset allocation. Asset location refers to spreading investment dollars among various account types, the location of the investment asset, and choosing the best investment type that works best in those particular accounts. The two basic type of investment accounts are taxable accounts and tax-deferred accounts. When you invest in a taxable account, such as a regular brokerage account, the amount of money you invest is not tax deductible. You've already paid taxes on the principal, nor does it grow tax deferred. Instead, the investor is taxed on any interest and dividends received during the year, whether you withdrew and used the funds or not. You're also taxed on capital gains if and when an investment is sold at a price higher than it was purchased. With tax-deferred accounts, such as IRAs and 401ks, the money invested grows tax-deferred until you actually physically withdraw the money from the account. Tax diversification, looking at a 401k versus traditional IRA versus a Roth IRA. Many investors wonder which is best, a 401k, a traditional IRA, or a Roth IRA. You may want a combination of all three. The general rule of smart personal finance is to always contribute at least enough to a 401k to receive the full employer match. You don't want to leave free money on the table. If you can afford to save more for retirement, consider additional investment types by investing that money in a Roth IRA, for an example. When choosing between traditional, which is pre-tax, and Roth, after-tax contributions, the general rule is to use a traditional IRA or traditional 401k if you expect to be in a lower tax bracket in retirement. A higher tax bracket now with money going in pre-tax will save you some tax dollars today. If you expect to be in a higher tax bracket in retirement, then using the Roth IRA may be a better choice for you. If you're in the same tax bracket in retirement as you were while making the contributions, the traditional and Roth IRA will essentially have equal benefits to you. The challenge in choosing between traditional and Roth IRAs is that there's no way to accurately predict what the tax rates will be 10, 20, or 30 years from now. For this reason, it can be smartest to have both types of retirement accounts. And keep in mind that employer matching contributions are always made on a pre-tax basis. So make sure you're taking advantage of those with your first dollars. Similarly, it can be wise to have a regular brokerage account in addition to your retirement accounts because of taxation. All qualified retirement accounts grow on a tax-deferred basis, and withdrawals are taxed as ordinary income regardless of the investment within the qualified account. However, withdrawals from taxable accounts from the sale of securities such as stocks, bonds, mutual funds are taxed at capital gains rates. Roth IRAs are a little different because the contributions are after tax, meaning you've already paid taxes on the contribution, and qualified withdrawals are made completely tax-free. So if you want to retire before you become eligible for full Social Security benefits, it can be smart to have accounts where withdrawals are taxed at a lower rate or not taxed at all. In those first critical years of retirement, you want to make sure you're pulling dollars out wisely. This, of course, depends on your individual circumstances and financial needs. So let's look at tax diversification benefits. As you may have guessed already, the benefits of tax diversification, spreading savings among various account types, are similar to those of investment diversification. It reduces your risk, and in this case, your taxation risk. For example, most people pay a long-term capital gains tax rate of 15% for investments in taxable accounts, though the exact rate will actually depend on your income level. So for retirees who withdraw at least $40,526 throughout 2021 tax year and $81,000 for married couples filing jointly, this tax bracket would be at least 22% instead of 15%. However, your ordinary income tax bracket may be much higher than that. You'll get the most out of tax deferral by leaving your 401k and traditional IRA money untouched and growing tax deferred for as long as possible. Depending on your tax bracket, it may be wise to withdraw from taxable and Roth IRAs first in retirement and to withdraw from tax deferred accounts later on. But again, without knowing your specific circumstances, the opposite may be true as well. When working with my clients in the distribution phase of their financial planning, we are often using a combination of all three account types at any given time to ensure the most net income to them after taxes. Because they've prepared well for retirement with different account types, we can modify how we take monies out when the tax environment changes to suit my clients' financial needs more efficiently. If you only have a 401k, your options are limited and you're at the mercy of whatever taxes are at the time. So what is the bottom line on tax diversification? No one can predict what tax laws will do, especially decades in advance. Investors should carefully think about possible taxation scenarios in retirement before making long-term decisions on the types of accounts to invest in. For example, it's wise to consider the chances of being in a higher tax bracket or a lower tax bracket in retirement and then invest accordingly. If you're not sure what tax bracket you'll be in during retirement, it could be wise to have assets spread across the different account types, such as a traditional IRA or 401k, or a Roth IRA or the Roth 401k. This is essential to giving yourself options at retirement so you can decipher what will give you the most net income in your retirement years. Taking a combination of the different types of accounts is a more common options for my retired clients. This is helpful in lowering their tax bracket in any given year throughout their retirement years. We also strategize how they're going to take their income in segments of time so we can regularly evaluate and modify to continue getting the most net income possible, while also planning for cost of living increases throughout their retirement years. This is where our years of tax planning becomes extremely valuable to our clients. Again, if you're solely invested in your 401k, your options are more limited and you're at the mercy of whatever the prevailing tax brackets may be at the time. So this is the part of today's Friday's Focus on Finances where we have full disclosure. Because we're giving you more strategic and more investing information, I want to make sure you know I'm not providing any specific tax, investment, or financial services and advice here. This is information and is being presented without consideration of the investment objectives, risk tolerance, or financial circumstances of any specific investor and might not be suitable for all investors. Past performance, of course, is not indicative of future results. So remember, investing involves risk, including the possibility of losing principal. So if you're interested in knowing how the strategies discussed today may benefit your individual circumstances, take advantage of our complimentary consultation. I would love to talk to you about your individual circumstances and your financial goals. Thanks, everybody. And I look forward to seeing you all next week on Friday's Focus on Finances. Have a great weekend.